Hi there, am I live now?
Yes, you are live.
Okay.
Can you guys confirm that you can
Let
hear me?
me just know when you want me to talk. Is there an intro or anything?
Yes, I can give a quick intro. All right, everyone. So we have Bruce Fenton here. He's the creator of Satoshi Roundtable and also the CEO of Chainstone Labs. He'll be doing a presentation on advanced wealth management and asset protection in a Bitcoin world. And I'll let him take it from here.
Okay, thanks. Hi, everybody. I hope you're doing well. So in the theme of sort of future-proof, I've been thinking a lot for a few years about sort of what the future of wealth management, asset management, how people will manage their money in the future. That's the background that I had before I got into crypto. So I have a little bit different lens about how how people will be likely to manage their money. There's a lot of things that are sort of the way that it is in the financial world that don't necessarily jive well with crypto. For example, custody. If you're a registered investment advisor who advises people like I used to, you're really going to be super, super cautious about wanting to have custody of any kind of asset that could get stolen. So I've been thinking a lot about, but I also, really love the decentralized principles and all the benefits of decentralization, how fast you can move things around. And I think privacy is very important, the cypherpunk ideal. So I've thought a lot about like, what would the future of wealth management look like? And I don't have the answers, so I don't want to psych you up too much. I've just been thinking about some of the questions. So that's what I'll cover in this quick talk. And I'll try and be pretty quick. Where's my beard? Yeah, the beard came off. A lot of people grow a beard in the winter, but I tend to have one in the summer. But it was getting a little bit much. um, so so I'll talk a little bit about the current systems for security and the investment industry and how they're changing. And then we're going to talk a little bit about how I think people might manage wealth in the future, and in line with the theme of the Future Proof Conference, how do you sort of protect that? And to do that, we'll talk a little bit about what the current systems are and how they work, and how these systems might work with Bitcoin and distributed ledger technology, and how the future might look. So first step, I think hopefully we all know this, Bitcoin is money. Okay, that's the main. Bitcoin is trying to do something different than what a lot of other crypto assets are trying to do. And that's not the theme of this talk, but it is important to note that that is very different than some of the other digital assets. Now, if you're competing with Bitcoin trying to be money, then there's a pretty good chance that it's not going to work. I'm not a believer that everything competing with Bitcoin to try to be money is bad, but I can certainly understand a Bitcoin argument against those types of projects, because it is very, very hard to create new money. But I think there would probably be uses for it. But what I really want to talk about in this is the uses that are not money, like securities, for example. Securities, other properties, commodities, ways to represent contracts, these kind of things can have a lot of value. So at a very, very simple level, if you had a token that the board of Apple said, if whoever owns this token is entitled to X number of shares of Apple, and they can vote Apple. Well, that has real value. There's no doubt that that has value. You can have arguments about whether you think it's a good idea to do that, or why you have the chain, or whether you even need a blockchain for that. Those are all very valid, but it definitely has value. So there's a category of things that have value that are not money, and that is a big piece of people's lives. A lot of it isn't even isn't even used for transactions. So anyway, we'll talk a little bit about that. And the major industry changes, there's a lot that's going on that is kind of all coming together now. We have changes with what we see in Bitcoin and cryptocurrency overall, the security tokens, which I just touched on. The way the world is working, I think that investors in the future, when you have a Bitcoin world where you have people who are used to being able to send their Litecoin from one country to another very easily, I think it's just natural that they're going to demand to be able to send other assets that way. So what this does is creates a different paradigm for how things can work. If you make it easier for people to trade agreements and trade things that represent value, and that's really what decentralized ledgers do at their core, it can really radically change how we represent value and how we manage our wealth. Right now, there's a lot of wealth, and you may own some wealth that is around you that isn't represented, not only not represented by a token, but it's not really represented by anything tradable. Most securities in the world are not tradable. They're private businesses. So the private business still has shares, anything from a very small business to large private businesses, and a lot of real estate is represented by shares, but it's not really traded anywhere. And you may, like I say, you may own some of that value. You may own a home or part of a home or something like that, and unlikely that that is that's sort of tokenized. So one of the major changes is what's going on, and I'm primarily talking about Bitcoin here, but also with Ethereum and all kinds of other chains that are working on this same kind of thing, which is making smart contracts work and making something that can represent value change. So I'm not going to go into details on each of these projects. I'd encourage you to look at them yourselves. But three of the ones that I'm excited about being built on Bitcoin are RSK, the Liquid Network by Blockstream, and that of course works with Lightning. All of these really ultimately work with Lightning. That's one of the things that's exciting about it. And RGB, which is newer and doesn't have kind of the corporate funding, but very open source cypherpunk kind of thing. So there's a lot of ways that these kind of this technology of putting smart contracts, and when I say smart contracts, one of the things that the ultimate smart contract, in my opinion, is a security, and a security really is. That's really what it is. It's a contract. There's a lot of different legal definitions in the United States. It's defined as stock, bond, investment contract, evidence of indebtedness, all of these different things. If you boil that down, it basically means sort of a tradable agreement, a tradable obligation. Okay, and that's really what a contract is. A contract is, in that example, the reason I use that example of Apple, I say if the board voted something to say that this token or this thing represents shares, and that could be anything, by the way. I mean, you could have a toy that somebody votes, or a key, a copper key with a special serial number, and if somebody said, this represents X shares in my company, that's going to be considered a security. And I'm sure the securities regulators would consider that a security. So you don't avoid or change the status by the structure. It's just a matter of, can you make a structure that works a little bit better? So if securities are basically contracts or agreements or tradable obligations, what is that? So the first one was very interesting. And this is a great chart because it shows how large this company became. The Dutch East India Company became worth about almost $8 trillion in today's money, adjusted for inflation. So it was bigger than Apple, Google, Microsoft, Berkshire Hathaway, all these companies combined. It was very, very huge. And why was that? What made that happen? Well, it was simply an agreement that was, in the days before tokenizing, it was an agreement that was put into a tradable form. So prior to this, if you had shipping expeditions, prior to this first joint stock company being created, if you had shipping expeditions, each investor invested what they could, and nobody pooled the money or shared the risk. And this was the first company to pool the money and share the risk, which is obviously, a super brilliant idea. The creation of this is one of the greatest creations in economic history. I mean, it completely changed the world. I mean, look at the companies on the right side. That's just a sliver of the examples of all of the companies that have used this method. I mean, the something as simple as stock, it's we forget how incredible it is because it's been with us for hundreds of years, but it's an incredible, very, very good, very efficient method of sharing risk. And for most of its history, it hasn't really changed much. I mean, you look at these pictures going back 400 years through to today. I mean, even Tesla as a very modern company and Facebook as a modern company, you still see these shares. Physical shares like this are very rare these days, but the systems running it are very much based on these physical shares. So the system is very antiquated and has a lot of challenges in it. That's one thing that a lot of people don't understand. They don't understand why we need tokens. If you understand how the ledger works, it's very, very complex. Here's sort of a diagram that explains it. But basically, what this comes down to is a Byzantine general's dilemma problem, which is sort of what Bitcoin partly solved with the creation of a decentralized ledger. What you have is multiple people or groups running ledgers who don't trust each other. So if you look at this, and I kind of purposely didn't, it's purposely not clear because it's a very complex system. So my illustration there was sort of to show how complex it is, because you have all of these different parties, transfer agents and registrars and brokers and clearing firms and prime brokers and all of these other things. And they've all got to communicate with each other, and none of them trust each other. So, let's see. Somebody's saying they can't see the slides. I see them on my side. Well, anyway, hopefully what I'm saying makes sense, whether you could see the slide or not. The point is that it is, doesn't say, not changing slides. Let me think. So can you see the stock certificates or anything? I see them on my preview here on my side. You see me. Oh, okay. How do I change? Let's see. I thought you would see the slides. East India compared to modern companies. So it's not switching for some reason. Well, sorry about that. The next slide was just, so there was the comparison of the modern East India Company, and then there was just some illustrations of stock certificates that I was talking about, making the point that the current system is pretty antiquated. And then the other slide I was talking about. So some people can see it, some people can't. It looks like interesting. Okay, and it says I'm definitely in presentation mode. It looks like I didn't change anything between the slides, so I'm not quite sure. But anyway, the basic point is that it's very counterintuitive, complex, and slow. The current system relies on a lot of different parties who don't trust each other to run the ledgers. So a token can solve that, because with a token, the ledger is run by the blockchain. So you know when somebody has 100 Bitcoin and they send you 10 Bitcoin, you know that that's real because the ledger tells you it's real. This distributed ledger with a whole bunch of people verifying what is true tells you what is true. So you don't need somebody to trust. Now, in the ledgers for stocks, it's not that simple. You don't have a blockchain typically. So you have to have, who knows what stock you have. Is it the issuer? Is it Apple if you own Apple stock? No, actually it's not. Apple doesn't know the shares. Is it your broker? Well, sort of. They have a piece of the ledger. They know you have shares, but they're just relying on others to tell them that that's true. And they certainly don't know who else has shares, because their competitors are not going to share that. So you have these very complex ledgers that are very counterintuitive, and a lot of that can be solved. Now, once that's solved, that creates a lot of exciting changes. These technologies, when they first came about, I call it, they were early ledgers. You didn't really have wallets, but you had almost bearer shares in the early days. And through lots and lots and lots of changes, you had that kind of way that the shares were held through changes in '96 with the DTCC and a whole bunch of other things, which I won't bore you with. The way that they held became increasingly confusing and increasingly obfuscated for for investors to figure out actually where their money is. And you don't really own the shares that you think you own in your brokerage account. It's held through a series of promissory notes. Now, the point isn't that it's all about to fall apart. It works. It just doesn't work very efficiently. So we do have a better ledger. We have a better way to make this work. And I'm not really sure if you're seeing the slides or not. So let me just see which ones. Okay, I only have a few more slides. So for those of you who can see the slides, great. It's just pretty generic stuff. I'm talking about a ledger, and then a couple bullet points, and that's it. So because of this better ledger, what's exciting to me is what does that mean? What does it mean that we can do with a better ledger? If we can make this work better, and these agreements, these tradable agreements called stocks or securities, work better and have smarter contracts or smarter securities or smarter stocks, what does that mean? It means a lot, and I could talk about this for an hour, but it means that more people will be able to issue more securities. So remember when I talked about that value that's around you, your apartment building, your house, your favorite local restaurant that you love to eat at. These things typically are not tradable. They're securities, but they're usually very, very closely held. So typically they are a business. So maybe the local restaurant owner owns 100% of the shares, or the owner of the apartment building might have a couple partners and they each own a few shares, but they're not the kind of things that trade. So before YouTube, not long before YouTube, you had 3, 4, 5 channels. You had ABC, NBC, CBS. Later, Fox came along, and you had PBS. That was it. And all the video content you wanted to watch, you watched through that. I was telling my kids about instructional video because they're so lucky in this generation. Gen Z can just watch any instruction in the world. And when I was growing up, if you wanted to see an instructional video, you had to really be dedicated. You had to go and order a video online, and there wasn't that many. The barrier was quite high. Now anybody can make a video, and therefore there's thousands of different teachers that you can have. So what YouTube did for video, they made it so that you had this long tail where you had not just a few choices, you had kind of all this value that was already there. It didn't necessarily directly make people smarter, although it kind of did. But it basically, you took all of these creators out there, these chefs and everybody else who can teach people, and made it so they can do that in a mass audience. Making securities work better could do is make all this value that is around you, your favorite restaurant, your apartment building, maybe even your vehicle, if it's a value, all of these things can be unlocked. And you could have, instead of typically people owning a handful of stocks through a fund, you might own thousands of stocks. There may be tens of thousands of stocks that are traded, stocks and other securities that are traded, and all of this value is unlocked, and it enables people to be much more granular in their investing, and they can be very specific about the types of entrepreneurs and investors they want to support, and there's more community ownership and localization, and all of these things work better. It moves around easier, you can transfer your heirs, and it works great. So yeah, it looks like, so sorry about that. It looks like some people are still stuck on the old slides. Not sure why that is, but you're not really missing anything. It was just basically what I just said verbally, and then the last slide has a picture of New Hampshire, which I certainly would encourage anybody to come up and visit. We love talking about these things. I think it's a really exciting time right now. It's an exciting world. There's a lot changing in our world and global economics, and I think that the way that capital markets work, the way that stocks work, changing is a really radical and exciting thing that can change the way our whole world works, because we can then put it's all about sharing risk and reward. We can put financial risk and share the reward in all kinds of different businesses. So with that, I'll conclude the formal part of the presentation and then open it to questions. If you have questions in the chat, I can read your chat and answer those. I think we have about 10 minutes, so feel free to ask any questions that you have about securities, crypto in general, this kind of concept, smart contracts, anything like that. Go ahead. And if anybody's hesitating to ask the first question, we could skip the first question, go right to the second one, right? Any questions? So one thing I can highlight a little bit more, a lot of people ask about is, why not just use a database? So the answer to that is that we're already using databases. Databases are, exactly how they keep track of these shares now. Okay, question tab on the left. I only see the chat bar, sorry. Do you see anything? Question tab to the left. I don't have a left tab. It says clip moment, video live. Sorry about that. If anybody could tap, I don't have a link to the presentation. I can put that in there. Okay, great. So I see the questions in here now. So this is a great question. Will the future of wealth management be held in smart contracts without a third party? So I think that if you have bearer assets, custodians are really important, and there are intermediaries and functionaries that act like custodians, investment advisors, brokers, and other sort of centralized parties that actually just serve a good need. I mean, people want to have convenience. You don't necessarily want to have your money in a whole bunch of different places, especially if it's crypto that can be moved around and you don't want to lose it or have it hacked or stolen or something like that. So I think there will be a need for third parties, but they're going to be more voluntary. Right now, you can't really take your shares off of Merrill Lynch, but I think in the future you will be able to. But you may not want to. You may not want to. I wouldn't want to take my shares out of a broker, and not just because I'm biased, but because it exposes a lot of risk. Very early in my career, I would ask people, do you have any old certificates around your house? Because older people would have stock certificates and things sitting under their bed, and they could get, burned up or lost or something like that. It doesn't really make sense. There's a lot of benefits of having that in. Let's see, ask a question. Okay, good. So I see the questions came over on this side. Why do so few of the revolutionaries from the 60s and 70s slow to get on the board for the real revolution? Yeah, I get, what is the old saying? I guess when you have all revolutions, live to see their revolutionaries become the tyrants, something like that. Yeah, I mean, I think that the revolutionaries from the 60s and 70s are very much establishment now. What are my feelings on DeFi? And I'm going to go through these quick because we're limited in time. DeFi, I think, as a concept is great. I hate the tokens. I mean, DeFi is a wonderful concept. I think it's very exciting. I think it's very interesting. You just got to be very careful with putting any economic value or buying any of these tokens, because you're not really getting anything for it. I mean, you're getting what? Like a thing that says you believe in the protocol. Well, okay, but how is the protocol going to make money? And if it is, do I get some? Because that's what an investment is for. If it's not an investment, if it's just for fun, that's fine, but don't put money in it then. You want to separate, sort of fun. There's a lot of projects that I support for fun, but I don't think they're a good investment. DeFi, there probably will be some good investments, but I'd be very, 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 very cautious. And I haven't seen any yet. And I like things that are, securities. I think securities are the big thing, which I guess I can answer the next question. What's next for crypto? I think that the next generation will be securities. I think securities just make sense. And the reason for that is because it's a definition that's really broad. It covers stuff like stocks and bonds, which are excellent and excellent structures. So it's just natural that they're going to want to move around the way that crypto can move. Natural resources, do I imagine natural resources might be tokenized? Yeah, I think so. One easy way to do it, or easier way to do it, is as a corporation. So if a corporation owns natural resources, then that's just a tokenized security. It could be a stock. The natural resources themselves, it depends what it is. It's hard to trade things like oil and gas because so it doesn't work as well as a security or money does for that respect. But certainly they've been traded a lot. So I think that any time where you could benefit from decentralizing the ledger, that would be that would be a positive. How do I feel about banks getting the green light to custody private keys? I think it's great. I think it's great because it will add to more an increase in people using these these technologies at organizations that they understand. And I do think that there's a place for custody. I mean, there's a lot of people, I have a lot of good friends who have $10 million worth of Bitcoin. And I think you'd be crazy to hold that in a place where somebody could rob you with a gun. It's the same reason we didn't hold gold coins in our own possession back in the days that people used gold coins as money. So I think it's great. Now, central banks and to protect your money. It's two different things. I'm not a fan of central banks, but I say everybody's welcome to the party. The more the merrier. To repeat what I said about Lightning. So all these projects like Liquid and RSK and RBG are building on Bitcoin, and they're all sort of pro Lightning and can integrate Lightning to various degrees in their in their implementation of their protocols. So hopefully, and if you believe in Lightning and you believe in the overall thing, this will work. All of these hopefully will work with Lightning, and you'll be able to use the scaling that Lightning creates to move these assets around. So that could be very exciting, because Lightning, and then you sort of solve two problems, and that would really. There's a lot of people kind of quietly working to make Bitcoin a much more serious contender to Ethereum on the smart contract side. There's a lot of people on Bitcoin who don't care about smart contracts, but there is some who feel like that should be the natural best chain. I like it. I support it. That's one reason I support Bitcoin. I also support Ethereum, though. How about coins like Nexo that give Bitcoin annual returns? Again, I go back to, if something is a security or not. If it's not a security and it's sort of tried to avoid that definition, it's not avoiding the law, it's avoiding the definition. Avoiding the definition, you tend to strip out a lot of the good terms. I don't know much about Nexo, but I'm cautious about a lot of these mechanisms that have returns, and when you hear about annual interest rates and things like that, I'm skeptical of a lot of it. Yeah, I think dApps have future. I mean, the whole concept of decentralized and distributed sharing of value and sharing of risk is kind of what we're talking about with tokenized securities, and you can have unconventional securities. There's a lot of interesting unconventional securities out there, like co-ops, and I think the next generation of that is dApps, which make it so that you can share that value in unconventional ways and share the risk in unconventional ways, and you don't even necessarily have to have the kind of corporate structure or organization that you would normally have with securities. Positioning itself over, do I see BTC positioning itself over coming years as more of a store of money or an easy, affordable way to make fast payments at scale? I don't think it'll win in the fast department, because there's always somebody who can make a faster blockchain. You can make the second layer stuff very fast, like Lightning is trying to do, and that's really what matters. So Bitcoin, again, is trying to do something different than what a lot of other things to do. It's trying to be money, and money has its properties and principles, and actually technology about moving it around isn't even part of it. It's just that the money has to be portable, which is why those big giant stones were not good money, and Bitcoin in that respect is a good form of money. But that is different than the transaction speed of what secures the network. So if it's purely about speed, I think that there might be something else that would or at the very least second layer solutions that would do that. But I think Bitcoin will be more of a store of money. And if Bitcoin wins, it's going to be winning on the value proposition of being strong money and a very strong, very hard to mess with chain. Failing at a local level. Okay, I don't think that's a question. Biggest regulatory legal blocks to micro-securitization. Well, in the United States, there's certainly a lot of regulations about how securities are offered, and those are quite strict. They are getting better. They're slowly. There are things like the reg crowdfunding, which is $1 million now, and the SEC has proposed increasing it to $5 million, but that is still quite a bit behind some of the other countries in the developed world. So the overall securities regulation is a barrier. And hopefully we can change that. I think, and all of that relates, by the way, to the accredited investor rules and the rules about solicitation. That's why you have exemptions and the difference between fully registered and exempt offerings. I wish that we could get rid of quite a bit of those, because I think it would change the world for the better. And I think I'm coming up to my time now. Sorry, I didn't get to these other questions. Please check me out on Twitter. If you follow me on Twitter, I can try and answer some of these in the future. And hopefully we can continue the conversation there.
Thanks, Bruce. This was a really great presentation. We're going to transition to our next talk now. Thanks
Great.
again.
Thanks a lot.